Price moves like a rubber band. It stretches away from where it lives, and then it snaps back. Not sometimes, always. Today we'll learn what that anchor is, how to measure when price has gone too far, and what that tells you before you act on a setup. Every trend pulls against an anchor, so what is it? We call it the mains. On most charts, it's the 21 EMA, the same line we covered in the moving averages video. Roughly a month of price memory, fast enough to react, slow enough to stay clean. On ArcAlpha charts, the daily 21 EMA is labeled mean for exactly this reason. Price spends most of its life near it, some bars above, some bars below, always returning. Mean today, mean tomorrow, always the means. This isn't magic, there's a reason it keeps happening. It comes down to trader psychology. When price runs hard above its mean, the people holding longs start counting profits. Some take them, they sell into strength. Supply hits the tape. Meanwhile, traders who miss the move are waiting for a pullback. They won't chase up here. So the buyers thin out at the same moment sellers show up. Price drifts back toward the mean, where the dip buyers finally step in. On the downside, the same thing runs in reverse. Stretch too low, short sellers cover, bargain hunters bid. That's the pull, that's why the mean keeps winning. Saying price is stretched isn't enough, you need a number. That number is ATR, average true range. It tells you the typical daily move for this stock. Measure the distance from price to the mean, then divide by ATR. 1 ATR away is normal breathing room. 2 ATR away, price is reaching. 3 ATR or more, price is overextended. The rubber band is taut. Take NVDA in March 2023, early in the AI rally. The stock ripped well above its 21 EMA. Multiple ATR units extended in just a few weeks. Then it cooled. Price drifted back toward the mean before the trend continued higher. The further price runs from the mean, the harder the snapback tends to be. Here's the catch, mean reversion isn't universal. In a range-bound market, reversion works almost mechanically. Price stretches, snaps back, repeats. In a strong trend, reversion fails. Price stays stretched for weeks while the mean chases it. So before you treat a stretched price as an opportunity, check the regime. Flat 21 EMA, price oscillating around it, reversion territory. Sharply rising 21 EMA, price pulling it higher, that's a trend, not a setup to fade. 2 questions answer this. Is the mean sloping? Is price respecting it on pullbacks? Get the regime wrong and you'll fade trends that crush you. Regime first, stretch second, always in that order. There's a second way to use the mean, and it's the one most professionals lean on. In a healthy uptrend, traders don't fade the move. They wait for it to come back to them. They wait for price to pull back to the 21 EMA, the mean, and watch what happens there. If buyers defend the mean and price bounces, the trend is intact and continuation is on the table. If price slices through the mean and keeps falling, the trend's character is changing. In a downtrend, rallies back to the 21 EMA become the test. Sellers step in there or they don't. Pull back to the mean, defend it at the mean, continuation from the mean. That's the textbook setup. Same direction as the trend, better entry, tighter risk. Bringing it all together. The mean is your anchor, the 21 EMA on most charts, labeled mean on ArcAlpha. Measure stretch in ATR units. 2 is reaching, 3 or more is overextended. Reversion works in ranges, trends override it. Regime first, stretch second. And in trends, the cleanest entries come on pullbacks back to the mean. Where price sits relative to its mean is one of the inputs ArcAlpha weighs into the setup strength score on every chart. Bullish setups score highest when price is above the mean but anchored close to it. Bearish setups score highest when price is below the mean and stays close. The further price is stretched from its mean, the more the score penalizes that extension, because the tauter the rubber band, the harder the snapback tends to be. This is algorithmic analysis for educational purposes, not a recommendation to buy or sell any security.